Jim, as we reopen, there's just a huge debate going on every single day on programs like this and conversations you have with clients, I'm sure, about how much cyclicality, how much more risk you should add to the portfolio as this economy reopens, as more parts of this economy reopens, and slowly, maybe even quickly, we get back to normal again. Jim, how do you manage that exposure in the months to come?
Yeah, it's a good point. I think there's obviously, I think, a long time to get back to the 2019 level. But when you think about, the last couple months, we are going from an economic shutdown to a reopening. And I think what you'll find here is the data, there's going to be a cyclical nature off of the lows of that data that we saw in April and early May here. And as the economy starts to reopen, we would expect to see acceleration of demand here because you still have consumption trends, you still have pent-up demand over the last couple of months. I would say the high end or the high net income brackets are not really going to be affected here, and you'll still see consumption there. There's a significant amount of stimulus coming in, from both the monetary support and the fiscal support. So I think in the short term, you'll probably see another 4 to 6 weeks of data that is going to look very positive off the lows. But then as you start to get into Q3 and Q4 and into next year, I think, this will still have a more normalized recession relative to 2019, and it will take some time. And I guess Mike said there are businesses, there are municipalities that are not going to make it through here, and obviously that is going to cause some length here with regards to trying to get back here. So we are. I would say we're pretty positive from a risk perspective right now. We do like the credit markets here, obviously because of that dynamic of an economic recovery here combined with monetary and fiscal support here. From a credit standpoint, the high yield and broad and the leveraged loan markets are pricing in 35 to 40% implied default rates over the next 5 years. And we think that's true draconian based off of where we see the recoveries coming in. So we do like risk here, and obviously we like the credit markets in the short term.